Hello fellow intelligent investors, my name is René Zellman and in this video I want to talk about valuation multiples. And more specifically I would like to talk about the so-called price to book ratio and discuss why a high price to book ratio or multiple may actually be a positive signal. Once you truly understand this, I think you will be a better investor, so make sure to stick around until the end of the video. So here's the structure of today's video. I will first explain what the price-to-book ratio is. In a second step, I will then illustrate how you can calculate the price-to-book ratio yourself by looking at the financial statements of a company. And for this purpose, I will take a look at Apple's most recent annual report. And lastly, and maybe most importantly, I will outline why intelligent investors can ignore the price-to-book multiple for the most part and shouldn't really include it in their analysis. So without further ado, let's get started.
Have you ever wondered how you can make your hard-earned money work for you? Have you ever dreamed of building generational wealth and leaving a legacy? My name is René Zellman and I'll teach you how you can manage and invest your money with confidence, a long-term vision and without losing your mind. Join me on my journey of intelligent investing and learn how smart people can compound their money effectively and accumulate wealth.
Alright, before I present my take on the price-to-book ratio, please let me know in the comments down below whether you use this multiple in your analysis. What are, in your view, the strengths of this approach and maybe what are the major disadvantages of the price-to-book ratio? Which other valuation multiples do you use, if any, and why? I would love to hear your thoughts. Okay, so for starters, most valuation ratios are incorporating the stock price or the entire market cap of a company or a company's enterprise value and then evaluate it to some accounting profit or cash profit to identify how cheap the business is. The mother of all valuation multiples is certainly the price to earnings multiple, short PE ratio, that you can find pretty much on every financial website. Personally, I think the PE multiple has some major flaws, but this should not be part of this video. Other well-known multiples are price to free cash flow or enterprise value to EBIT, or maybe also Peter Lynch's PEG ratio or PEG ratio. And the price to book ratio is yet another valuation multiple. However, the price to book ratio is a valuation ratio that is a little different than the other ratios I just mentioned. The numerator is still the share price or the entire market cap of a specific company. But the denominator is a company's book value per share or the book value of the entire company. So unlike PE or price to free cash flow, the denominator is not some kind of accounting or cash profit, but a balance sheet item. As I just said, the book value of a company, also known as equity, can be found on a company's balance sheet. And it is the difference between total assets and total liabilities. Let's pretend you are buying a house that is worth $100,000. You might make a down payment of 20%, so that would be $20,000. And you make that down payment in cash. And in addition, you get a loan of $80,000. Now the house represents your assets. The liabilities are your loan. And therefore your equity in the house is $20,000. In the corporate world, book value is an estimation of the value of a company if it were to be liquidated. It is the price relative to the firm being dead in a sense. And the price to book ratio is calculated by dividing the company's market cap by its book value, or by dividing the current stock price by the firm's book value per share. So if someone would give you all of the assets of the company, how much would you pay for that? If the ratio is below 1, you essentially get more assets than you are paying for. For example, a company with a share price of $100 and a book value of $110 per share would have a price to book ratio of 0.9. Lastly, I want to point out that some companies may actually have a negative book value. And as a result, the price to book ratio would also be negative. So let's just quickly consider a real world example. If we navigate to Apple's most recent 10K, so that's the annual report of the company, and then look at Apple's balance sheet, we can see that Apple currently owns assets worth $323 billion. On the liabilities side, Apple records $258 billion in liabilities. If we now subtract total liabilities from total assets, we get a book value of roughly $65 billion. We now need to take a look at Apple's share price, or actually the market cap of the entire company. And as of January 3rd, Apple's market cap is $2.25 trillion. If we now divide the market cap by the book value, we get a price-to-book ratio of 34.7, which is roughly the same ratio that we can find on the website of QuickFS. Okay, before we move on, be sure to hit the subscribe button and the notification bell, and maybe to leave a comment. I'd really appreciate any support that you can give to help me grow the channel more quickly. Now, strictly speaking, one can distinguish between price to book value and price to tangible book value. To calculate tangible book value, you would need to subtract all intangible assets, so assets that aren't physical, like for example the value of a brand, maybe trademarks or patents, and you would have to subtract that value from the value of the total assets. If there are any intangible assets, they will most likely be listed in the non-current assets section of the balance sheet. And some very transparent companies will further subdivide intangible assets into various subcategories, like for example intellectual property, goodwill, or other intangible assets. However, often intangible assets are not directly stated on the financial statements. For instance, the brand value of Apple will not be reflected on the balance sheet. So to calculate price to tangible book value, you only subtract those intangible assets that are actually listed in the asset section of the balance sheet. I would say overall price to tangible book value is an even stricter valuation ratio than the traditional price to book ratio. I know that beginner investors are always looking for some benchmarks. When exactly can I consider a stock undervalued? Should you invest in a company with a price to book value below 10? Below 5 maybe below 1? Well, while benchmarks can be helpful for beginners, I'm always careful when it comes to naming specific thresholds. Like firstly, and generally, valuation multiples are just one tiny piece of the bigger investment puzzle. And looking at valuation multiples in isolation practically doesn't tell you anything in my view. And I think it can in fact be very dangerous. I know that various value investors such as Kenneth Marshall, he's the author of the book Good Stocks Cheap, suggest a benchmark of 3 for the price to book ratio. But these investors look at all sorts of other quantitative metrics as well, such as return on equity, return on invested capital, various debt ratios, and also other valuation ratios such as enterprise value to free cash flow. In addition to these quantitative criteria, they are looking at qualitative aspects as well, such as the competence and the integrity of a management team. And in addition to that, I think another problem with the price to book ratio in particular is that usually the intrinsic value of a company is much higher than the book value. And therefore, book value is not necessarily a good metric to figure out whether a business is over or undervalued. And let me repeat what I just said here, because I think for beginner investors, realizing this is particularly important. A firm's book value is not necessarily equal to the company's intrinsic value. A company's intrinsic value is usually higher than the firm's equity, because you would not necessarily liquidate the company immediately, and the assets can actually generate future profits. Here's what Buffett once said about this distinction. Of course, it's per share intrinsic value, not book value, that counts. Book value is an accounting term that measures the capital, including retained earnings, that has been put into the business. Intrinsic value is a present value estimate of the cash that can be taken out of a business during its remaining life. At most companies, the two values are unrelated. And if you want to truly understand what intrinsic value means, I recently did a video on this subject, and I'll add a link to that video in the description box below. But put in a nutshell, the value of a firm is not the liquidation value, but the value of all future cash flows, discounted back to present value at some appropriate discount rate. And even if you would liquidate a company, you would probably receive less for various assets than the value recorded on the financial statements. Because breaking up a business and selling all of a business's assets is quite a complicated process. Here is how Buffett himself explained this problem in his 1985 Berkshire shareholder letter. I won't read out the entire quote, so I suggest you just pause the video here and read it for yourself. Buying businesses based on their price-to-book ratio is certainly the classic form of value investing. Originally, value investing started by placing a lot of emphasis on a firm's equity and book value relative to the firm's market capitalization. And this is also how Buffett began his career when he was more of a cigar-butt investor. The idea is that the value of an average or below average company might be flat or declining, but the price compared to the book value could be so low that buying the company is likely to produce a one-time return as the gap between price and value starts to close. Ben Graham, the father of value investing, he actually used an adjusted price-to-book ratio. He only used current assets and total liabilities. And the idea was that current assets can be converted to cash in 1 year or less. And so you could pay off the entire debt of the company, shut down the business, and take out all of the remaining cash and profit. So for old and declining businesses, sometimes shutting down the business and returning the capital to shareholders might actually create the most value for shareholders, because the business doesn't really have a future. But in reality, managers are almost always, I would say, reluctant to do that. They will do everything to keep the business alive, even though that might not benefit shareholders. And Graham also used another metric, which is nowadays referred to as the Graham number or the Graham multiplier. And he defined this ratio or this multiplier in The Intelligent Investor as the PE ratio multiplied by the price-to-book ratio. And the product of the two should be no greater than 22.5 according to him. So both companies with a low PE and a higher price-to-book ratio, as well as firms with a higher PE and a low price-to-book ratio, could actually pass his test. Even though Buffett himself started out as a deep value investor, you can consider this as maybe Buffett 1.0. In later years, Buffett recognized that intrinsic value and not book value, which is just an accounting concept, is the key to finding outstanding investments. And that's basically Buffett 2.0. And I want to bring up two more important points here before we wrap up the video. Firstly, nowadays we live in a tech-heavy and asset-light world, and many companies don't have a lot of assets on their books anyways. So generally, the price-to-book ratio is certainly more useful for asset-heavy and capital-intensive businesses. It's worth looking at for maybe energy, transportation, manufacturing, or also financial businesses with plenty of assets on their books. Secondly, when I buy a company, I want the company to be alive, and ideally alive for many years or decades even. A company's intrinsic value is primarily derived from the earnings power of the operations. And I don't really care about my stake in a dead company. I want the company to be alive. In fact, I try to make sure that I can predict with a high degree of certainty that the company will still be around in 10 years or maybe even in 20 years, and that the company will be more profitable than today. And this is expressed in my favorite valuation technique, which is the discounted cash flow method. Because here the value of a business is not expressed as the liquidation value, but the value of all future cash flows discounted back to present value. In essence, the price-to-book ratio only expresses what the company has right now. But while book value reflects what has been put into the business, intrinsic business value actually estimates what can be taken out of the business in the future. Here's Joel Greenblatt's take on this. We try to stick with companies that are gushing cash flow. We don't really think of value as a low price to book or low price to earnings. We are actually valuing businesses based on cash flows like a private equity investor would. What I would like to emphasize here though is that it is always worth looking at the asset side of a business, in particular the goodwill of a company. Because if a company carries a lot of goodwill, this may signal that the management team has actually completed some overpriced acquisitions in the past. Also, if you find a company with a price to book value well below 1, you might at least take a closer look at the company if that fits your or suits your style of investing. However, I also want to caution you that stocks trading at big discounts to book value can actually be value traps, because they might be operating in industries that have changed and future profits might not be what they used to be. Buffett himself has pointed out that he in fact is more likely to look at companies trading at a higher price to book value than companies trading at a lower price to book value. Here's what he said. If anything, we are less likely to look at something that sells at a low relationship to book than something that sells at a high relationship to book. Because chances are we are looking at a poor business in the first case and a good business in the second case. And this already brings us to the end of this video. I hope you enjoyed it, and if you did, make sure to leave a comment and to like the video. May your finances and investments prosper. Good luck.